In this session, we will look at the second part of the term structure of interest rates: liquidity premium theory, segmented market theory, and preferred habitat theory, in that order. First, liquidity premium theory simply states that short-term maturities imply greater liquidity, and therefore savers are willing to hold securities for a longer term if there is a premium offered on the yield or the interest rates. In other words, the longer you keep your money invested somewhere, the higher the yield or the interest rates you would expect. In effect, liquidity premium increases the slope of the yield curve. Short-term liquidity, lower interest rates; long-term, higher interest rates. So the yield curve should be sloping upwards if liquidity premium theory was the only theory that was applicable. Now, let us superimpose another theory on this, the segmented market theory. In any economy, investors and borrowers choose securities that match their needs. Insurance companies, for instance, would normally operate in the long-term market because all of their liabilities are long-term, and therefore their assets, i.e. the securities which they invest in, would also be long-term. On the other hand, commercial banks operate in the short and the medium-term market because the liability support they get is for the short to medium term. Hence, they prefer to invest only in short and medium term securities. This embedded preference by the participants in the financial system to either be in the short to medium term or in the long term lends another interpretation to this whole concept of term structure of interest rates. Insurance companies prefer the long term, banks prefer the short and the medium term. And the choice of the term, therefore, is determined according to the demands and the needs of the segment where that institution is operating. Insurance companies, pension funds, banks, and so on and so forth, rather than the expectation on interest rate movements as we saw in the pure expectations theory. There is a hybrid which is called the preferred habitat theory. Let's see what we mean by the preferred habitat theory. We saw just a minute ago that an insurance company under the segmented market theory will normally play in the long-term market. But as it happens, in most countries, most insurance premium payments by the insured customers are almost always paid towards the end of the financial year. So most insurance companies would therefore have an enormous amount of liquid cash with them towards the end of the financial year. Suppose interest rates and yields are not very favorable at that point in time, in which case the insurance companies tend not to invest in the long term, which is their preferred market. They would rather invest in the short term market until interest rates and yields move up, at which time they will move their investments to the long-term market. In other words, they invest a surplus fund in short-term instruments if they expect yields to go up in the future, which is based on the pure expectations theory. Therefore, while insurance companies normally operate in the long-term segment, there would be periods in time when they keep their money invested in the short term if, based on the pure expectations theory, they expect interest rates to go up going forward.